I learned the hard way that markets never collapse without whispering warnings first. It's the trader who refuses to listen that gets buried beneath the avalanche. I recall a campaign early in my career when a roaring bull market had everyone convinced the rise would never end. I was young, confident, and blinded by the speed of the advance, ignoring a series of subtle but unmistakable signals. Volume swelling on down moves, rallies shortening in length, and the tape revealing heaviness that only seasoned operators could sense. Instead of stepping back, I pressed my positions, believing momentum would carry me through. Days later, the decline began, not with drama, but with a tired, labored drift that quickly turned into a full-scale break, wiping out weeks of gains in a matter of hours. That failure taught me the truth the top 1% already live by. A crash doesn't arrive as a surprise. It arrives as a series of quiet warnings recognized only by those who study the market's tone, not its excitement. A crash never announces itself through a sudden dramatic plunge. It reveals its intentions quietly through the changing character of the rally long before the crowd senses danger. Most traders watch only for the moment price collapses, but the professionals observe the steady weakening that precedes that collapse. A healthy rally has certain unmistakable qualities. Demand shows itself clearly on up moves, reactions remain shallow, volume expands naturally during advances, and the market moves with purpose rather than struggle. But as a market nears a major top, this behavior undergoes a subtle but decisive transformation. The advance begins to lose its vitality. Rallies shorten in duration, price covers less distance with each push, and each effort to climb requires more volume simply to maintain progress. Instead of surging, the market begins to lean forward, as if climbing a hill that has suddenly become steeper. What separates the top 1% from the average participant is their ability to read this fatigue. They recognize that when a rally demands increasing effort for diminishing reward, demand is no longer dominant. They observe that reactions, once brief and quickly absorbed, now penetrate deeper and take longer to recover. Where one used to see clean, confident advances, they now see choppy, overlapping bars that betray hesitation. The tape begins to print a different personality. Up moves become sluggish, while down moves start to carry more authority. This shift is often so subtle that the public mistakes it for a normal pause within the trend. Yet to the trained eye, it is the earliest signal that the engine of the bull market is losing power. Another telltale sign is the growing dependence on emotional or news-driven surges to keep the rally alive. Near major tops, markets often require sensational announcements or bursts of public enthusiasm just to push slightly higher. These are not signs of strength, but signs of exhaustion. The professionals understand that when a rally can only advance on excitement rather than genuine accumulation, the underlying structure is fragile. They watch how the market reacts after these bursts of enthusiasm. If prices cannot sustain gains, if each rally is met with immediate selling, or if volume dries up quickly after the initial surge, they know the rally is operating on borrowed time. The top 1% also measure the effort versus result relationship with meticulous care. When large volume appears on what should be a strong advance but price barely moves, they recognize that supply is flooding the market even as the public sees only a rising bar. They understand that the market is no longer rising because strong hands are buying, but because weak hands are still willing to pay higher prices, not realizing they are absorbing the supply being distributed to them. This imbalance marks the final stage of a mature uptrend. By the time the actual break arrives, the professionals are already positioned or standing aside. They were not waiting for the crash, they were reading the deterioration that made the crash inevitable. To them, the decline is merely the logical conclusion of a rally that ran out of strength long before the crowd noticed anything was wrong. Distribution is never a single event. It is a process, a deliberate campaign carried out by informed interests long before panic hits the tape. The public imagines that crashes appear suddenly, sparked by news or some dramatic shift in sentiment, but the top 1% know that major declines are born in periods of quiet unloading. This unloading leaves a trail of footprints, visible to anyone trained to read the market's language. These footprints are not dramatic price drops or explosive volume spikes. They are the subtle signs that strong hands are transferring their positions to unsuspecting buyers. Every major top throughout market history shows the same sequence. Strength that appears genuine on the surface, but carries the unmistakable signature of supply just beneath it. The first footprint is the increase in volume on down moves. In a healthy uptrend, selling pressure is easily absorbed, reactions remain mild, and volume often contracts during declines. But as distribution begins, these reactions grow heavier. The down moves expand in spread, fall with more authority, and come with noticeably higher volume. This is not panic. It is calculated selling. Strong hands do not dump everything at once. They quietly push out inventory while the public still believes the uptrend is intact. When the tape begins to show consistent supply on these reactions, the informed trader sees the early architecture of a top forming. Another key footprint is the failure of rallies to retrace losses. In true strength, every decline is met with confident buying, and the market quickly regains lost ground. During distribution, the opposite occurs. After a weak decline, the subsequent rally struggles. It rises on lighter volume, lacks conviction, and often stalls before reaching previous highs. These rallies may even appear energetic on the surface, but the volume tells the truth: demand is no longer dominant. Instead, every rally is being used as an opportunity for large interests to unload more stock. The public interprets these choppy advances as continuation of the bull trend, while the trained observer sees a market being propped up only long enough for major holders to exit gracefully. A third footprint is persistent selling into strength. This behavior is subtle but unmistakable once recognized. The market may push to new highs, but instead of expanding with force, it labors to inch upward. As soon as price begins to rise, hidden supply enters the tape. Quiet but consistent. Spreads narrow during what should be strong advances, and volume surges at the very top of each rally. This is where strong hands place their largest orders, distributing stock to eager latecomers who believe they are buying into a continuation, not the end of a trend. The final footprint comes in the form of failed tests of supply. In a healthy market, a test on low volume confirms that selling pressure has dried up, but during distribution, tests fail repeatedly. Volume refuses to diminish, sellers reveal themselves quickly, and price cannot advance even when the tape attempts to lighten. These failures make it clear that supply is still present and dominant. By the time the public becomes aware of danger, the top 1% have already completed their distribution campaign. Their exits were executed quietly, months before the chart breaks decisively. Crashes do not surprise them because they have watched the footprints accumulate, each signaling that strong hands were preparing for a decline long before the crowd sensed anything at all. The tape always turns heavy before price turns down, and this subtle shift in tone is one of the most reliable warnings the top 1% rely on. While the average trader studies only the bars and the chart pattern, professionals study the feel of the market. How price responds to effort, how volume behaves in different phases, how easily or reluctantly the market moves when pushed. This heaviness is not dramatic. It rarely shows itself in giant red candles or panic-driven sell-offs. Instead, it emerges as a quiet resistance lurking beneath every rally, a sort of invisible weight that makes each advance feel labored and unnatural. When the tape becomes heavy, it signals that supply is beginning to assert itself, even if price has not yet broken down. The first sign of heaviness appears when down moves begin to produce more progress than up moves. In a strong market, a single rally can erase several days of decline. But near a top, this relationship reverses. A small decline suddenly wipes out multiple sessions of upward effort. The tape shows more speed going down than going up, even when the chart still appears bullish. These quick, efficient declines reveal the presence of professional selling, the kind that does not scream but speaks with precision. The informed trader knows this shift is not random but intentional. Another aspect of heaviness shows up in the spreads. During the final stages of an uptrend, one often observes wide spreads on down days and narrow spreads on up days. The market may still be climbing, but the ease of movement has changed. Upward effort requires more time, more volume, and more emotional energy from the crowd. Downward movement requires very little. A heavy tape is one where the path of least resistance has quietly shifted downward long before the crowd realizes it. The top 1% understand that this change in resistance is the real turning point, not the eventual breakdown. Volume also becomes an important indicator of heaviness. Strong advances should occur on expanding volume, but as a top forms, these signals become distorted. Up moves begin to show increased volume without meaningful price progress. Effort with little reward. This imbalance is a dead giveaway that supply is meeting demand aggressively. When the market requires significant effort just to rise a small amount, it means that large interests are selling into the strength. To the untrained eye, it may still appear bullish because price is rising. To the professional, it is the sound of the market creaking under its own weight. Even more telling are the failed responses to bullish news or emotional surges. In a truly strong market, good news produces strong continuation. But when the tape turns heavy, good news results in shallow rallies that fade quickly. The market no longer has the buoyancy it once had. It no longer floats upward effortlessly. Instead, it sinks back the moment excitement dissipates. This is a sign that the underlying demand has weakened dramatically. Finally, the market's inability to follow through on breakout attempts becomes the confirmation. Breakouts that once launched new trends now stall almost immediately. Instead of accelerating higher, they get absorbed. Another sign that supply is quietly overwhelming demand. By the time this heaviness becomes visible to the public, the top 1% have already positioned themselves for what comes next. They do not fear the crash because they recognized the shift in tone long before price revealed it. The heaviness in the tape is the whisper before the storm, and only the professionals know how to listen. There is a certain moment in every major decline when the truth finally becomes visible to the public. But by then the damage is already done. Long before the headlines begin screaming panic, long before the commentators on the financial networks start warning of trouble, the preparatory work for a crash is already underway in the quiet parts of the tape. One of the earliest and most reliable signals comes from the behavior of supply. Specifically, how aggressively large holders begin unloading stock into strength while the crowd is still convinced the trend is safe. Most traders only watch price, and because price continues to rise, they assume everything beneath the surface remains healthy. But the trained eye pays attention to how difficult it suddenly becomes for price to advance through levels it previously sliced through effortlessly. That subtle resistance tells the story. The big interests are no longer supporting the advance. They are feeding distribution into the very enthusiasm they created. I learned this lesson during a bull campaign in the early part of my career. The market had been rising for months, powered by strong confidence and heavy participation. Every dip was bought eagerly, but gradually I noticed something that disturbed me. On rallies, volume surged far more than the distance covered by price. That imbalance suggested excessive effort for little reward. And on declines, even shallow ones, volume expanded sharply, an unmistakable sign that selling pressure was emerging from skilled operators, not from nervous amateurs. Despite that, the public kept buying. They mistook the narrowing of spreads and slowing progress as healthy consolidation. But to me it felt like the market was beginning to lean under its own weight. The next major clue came from how the leaders behaved. The strongest stocks, those that carried the entire advance, began to falter. They stopped making new highs even while the index attempted one last push upward. This divergence is rarely accidental. Leaders top first because the same forces that marked them up months earlier now quietly close their campaigns. When the generals stop marching, the army is soon to follow. And when the best stocks can no longer lift the market, the crash becomes not just possible, but probable. Another giveaway was the character of the rallies. They became thinner, shorter, and more emotional. The public rushed in with blind optimism, but the operators who once encouraged that optimism had withdrawn. They no longer absorbed supply, they created it. Each rally became a trap, drawing in new buyers, only so their shares could be sold to them. The tape no longer behaved like a cooperative trend, but like a battlefield filled with decoys. When the market began to break support levels on increasing volume, the preparation phase ended. What followed was inevitable. Every major crash I witnessed afterward displayed the same early signatures: heavy selling hidden inside rising prices, leaders failing quietly, rallies losing stamina, and the public blissfully unaware. Crashes never arrive without a warning. They simply arrive without a warning the crowd is willing to hear. There is a particular kind of silence that settles over a market before a true collapse, an uncomfortable stillness that most traders misunderstand as stability. What they fail to realize is that before every major decline, the market enters a phase where volatility contracts, spreads narrow, and price appears deceptively calm. It is during this quiet stretch that the most informed operators perform their final preparations. They stop supporting the market. They stop absorbing supply. They stop encouraging the public's enthusiasm. And when their supporting presence vanishes from the tape, the market behaves differently in a way that only the trained eye can detect. The lack of sponsorship becomes obvious not through dramatic price moves, but through the absence of normal demand where it should be appearing. I recall studying a campaign early in my career where the market had spent weeks rising on diminishing momentum. Everything appeared orderly to the average participant. Smooth climbing, small pullbacks, stable volume. But as I analyzed the tape each morning, something began to disturb me. On the days when the market dipped into what should have been a natural demand zone, buyers no longer appeared with the enthusiasm they once had. Instead of snapping back with conviction, price hesitated. It leaned. It sagged. The bounces were weak, almost reluctant, as though the market had lost its internal strength. At the same time, the operators who typically absorbed temporary bursts of supply were no longer present. Their footprints, once clear as day, began to fade. The real confirmation came when I noticed that rallies sparked by good news had lost their energy. Instead of expanding in volume and spread, they barely lifted. Price would push upward for an hour or two, only to stall and drift, as if weighed down by invisible pressure. This is the behavior of a market being allowed to fail. When the strongest hands cease supporting it, nothing remains beneath the surface except the crowd's belief that the trend is still intact. But belief alone cannot keep a market afloat. Another sign was the increasing sensitivity to minor selling. A few months earlier, the market could easily absorb large orders without consequence, but now even a modest wave of selling created disproportionate movement. A sure indication that someone had stepped away. When professionals remove their sponsorship, every sell order becomes heavier, every downtick more meaningful, every test of support more dangerous. The market no longer acts like a well-supported structure, it acts like a hollow shell waiting for the final push. When the break finally came, it was swift, violent, and shocking to those who had mistaken quietness for strength. To me, it felt inevitable. The weakening rallies, the failing reactions, the lack of sponsorship, the inability to expand upward even on favorable news, these were warnings far louder than any headline. What appeared to the public as calm stability was merely the stillness before the ground gave way. The truth is simple: crashes are not born from chaos but from silence. They begin when the strongest hands withdraw their support and leave the market standing on nothing but crowd emotion. And once the foundation is gone, the fall is only a matter of time. Every major collapse in market history has followed the same timeless script, yet only a small minority ever recognize the signs. The public waits for headlines, predictions, and drama, while the top operators watch the quiet footprints that appear long before the world notices anything is wrong. Distribution hidden inside strength, leaders falling out of step, weakening rallies, rising sensitivity to supply, and finally the silent withdrawal of sponsorship. All of these warnings show themselves clearly to those who have trained their eyes to see beneath the surface. A crash is never an accident, nor is it a surprise to those who understand how the market truly operates. The decline is simply the final act of a long process that begins in calmness, unfolds in subtle imbalances, and ends in panic. Those who observe the signals early can step aside or even position themselves advantageously, while those who remain blinded by optimism are left to pay the price. The market always whispers before it screams, and only the disciplined listener survives the storm.